If you invest in stocks and mutual funds, you shouldn't overlook dividend-paying stocks or funds that invest in such stocks. And by the time you finish watching this video, you'll be able to answer the question yourself, why buy dividend stocks? So what's so great about these securities? Many things, but there are 5 major potential advantages to dividend-paying stocks. First, dividend stocks can provide a potential big boost to your portfolio performance. Second, they might help reduce your investment risk. 3, they could create stable and growing income. 4, they often give you a tax break. And 5, all these benefits can potentially happen all at the same time. Does that whet your appetite to learn more about dividend-paying stocks? I thought it might. Now, beware, not all dividend-paying stocks are created equally. And there are some important minefields that you need to avoid when buying these kind of stocks. I'm going to discuss those particular issues towards the end of this video, so make sure to stick around to the end. First, let's talk about what dividend-paying stocks are. When publicly traded companies have profits, they can either reinvest those profits in the company or they can give those profits to the owners of the company, the people who own shares in the company, or they can maybe do a little bit of each. Now, when the company pays out some of those profits to the common shareholders in this manner, that's called a dividend payout. Usually the dividend is decided on by the board of directors each quarter. Now, even though companies legally declare the dividend quarterly, most companies try to maintain consistency. So if they paid $2 per share last quarter, they'll try really hard to pay out that same or more every quarter thereafter. That's true of most stocks, not all. So for example, if you own 1,000 shares of XYZ company and the board of directors declares a dividend of $2 a share, since you own 1,000 shares, you'll get a check for $2,000 each quarter or more. Some companies allow shareholders to receive more stock instead of getting the cash dividend if they want. So in the example above, if the shares were trading at $50 a share when the dividend was declared, the investor could be entitled to receive another 40 shares rather than the $2,000, because if you take the $2,000 and divide it by the share price of $50, you get $40 a share. Other companies only issue stock dividends rather than pay out the dividends in cash, and investors can't choose between the two. For our purposes, we're talking about companies that pay out cash dividends only. Now, in most cases, in order for a company to pay a dividend, they have to have profits. So what that means is often if you buy companies that pay dividends, it means that they're profitable. And profitable companies tend to have less risk of going out of business than companies without profits. So buying dividend stocks generally reduces the risk you take when you invest in the stock market, all things being equal. Let's see how that worked in 2022 by looking at a chart of 2 funds. I'm not going to show you the names, but we'll just use 2 broad examples. Now, you already know that 2022 was a terrible year for stocks. And this particular growth fund was down over 30% for the year, and it's typical for growth funds. But the S&P was down about 20% for 2022. And you can see that this particular dividend fund was up actually 2% for the same time period, and that's quite a difference. So in this instance, the dividend fund protected the investor from a huge decline. Obviously, the past is no guarantee of future results, and you have to check with your own advisor before investing. But this last year really illustrates the potential way that dividend stocks might reduce risk for retirement investors. Now, why might dividend stocks decline less than growth stocks during market declines? One reason is they tend to be more conservative stocks, so their price has not been driven up by speculation that many growth stocks have. Speculative stocks both rise and fall much faster generally than conservative stocks. Also, because people who buy those stocks really want the dividend, they might be less inclined to sell just because the stock price goes down. They can afford to hold on because they've got that dividend check coming in. And since there could be fewer sellers as a result of that, that might keep the stock from falling off a cliff during market declines. Now, what if you buy companies that not only pay dividends every year, but companies that have increased those dividends in most of the past years. Well, in that case, assuming those dividends came from ever-increasing profits, you'd potentially have yourself a company that's more and more profitable each year and therefore less risky. And as I showed you before, dividend-paying stocks often overperform non-dividend paying stocks during market declines. Now, this can be especially important to people near or in retirement who might want a little appreciation during good markets as long as they can potentially dampen the declines during bad markets. Now, full disclosure, this worked really well during the last 3 bear markets, but during the last COVID bear market, non-dividend paying stocks actually did better than dividend paying stocks, so nothing's perfect. Now, companies that increase their dividends year after year are what's called dividend aristocrats, if they have increased their annual dividend in each of the last 25 years. Now, these dividend aristocrats are usually considered very secure. They do provide some potential growth, but usually not as much growth potential as, let's say, a profitable tech company that reinvests most of its profit into growth rather than paying out those profits in dividends. For example, look at this chart that compares a dividend stock, Procter & Gamble, compared to Amazon, which is a growth stock. Now, by the way, I'm not recommending either stock. I'm showing you this so you can see the potential pros and cons of growth versus dividend stock investing. And the past is still no guarantee of future results, so please talk to your advisor before investing. Anyway, you can see that even though Amazon had a rough year this year in 22, investors who bought it for growth still had a 600% return of their investment over 10 years versus 175% for Procter & Gamble over that same period. This shows you the potential growth of a growth stock versus dividends over the long run. But if you look at the same comparison for 2022, you can see that Amazon investors got creamed. They lost 50% of the value versus Procter & Gamble, who actually made a small profit. And you can see that dividend stocks could appeal to investors who are looking for more safety and don't care about maximizing growth. But again, you want to talk to your own advisor before investing. I'm not making any recommendations. Let's talk more about the potential benefits of owning dividend-paying stocks. Now, whenever you buy common stocks, there's a risk that the stock will go up and down. But at least when you own dividend-paying stocks, you get a check each quarter, theoretically, no matter what happens to the stock market. In other words, you make a profit on your investment no matter what happens to the stock. And since most companies that pay out dividends to their shareholders don't like to reduce or stop making dividend payments unless the business runs into big trouble, you'll get your dividend check even if the stock itself gets crushed during bear markets. That's usually the case, but not always. Companies are not required to pay out a dividend. They can and do sometimes suspend paying dividends when they get into trouble, as I mentioned above. Now, how do you select which dividend-paying stocks to buy? That's an involved issue, but I know it's one that you're asking right now, so let's look at it quickly. Well, one way for the most conservative investors to select dividend stocks is to buy companies that did not reduce their dividends during the worst periods like 2007 through 2009. But we're going to cover how to select dividend-paying stocks in our next video, so be sure to subscribe and click the bell icon so you get notified when we post that video. I want to take a detour and just clarify that in this video, we're talking about common stock dividends as opposed to preferred share dividends paid out on preferred shares. Preferred shares and their dividends are a completely different animal. We discussed that already, so make sure to watch that video. I've got a link to that video above, so click on that. Now, do dividend-paying stocks increase in value faster than stocks that don't pay a dividend? There's a lot of hype on this issue, and there are smart people on both sides of the argument. My suggestion is don't even worry about it. If you buy dividend stocks, do it to potentially reduce risk because you're potentially buying stocks that are safer companies while still providing some, although less, potential growth. Also, do it for the stable and potentially growing income that usually isn't impacted by stock market volatility. If you're looking to maximize your growth or total return, I think there are better alternatives than dividend-paying stocks. We cover and update that topic all the time, so make sure to subscribe and make sure you hit the notification bell so you know when our latest video on that topic is published. How much can you make in dividends? Well, some companies pay out very high dividends, and I'll explain later that that may not be the best company to buy. You'll see why soon. And some other companies pay out very little. Just to give you some bearing, look at the S&P 500. The average dividend yield of the S&P 500 is 1.8% today. That means if you invested $100,000 and bought a little bit of each stock held in that index, you would earn about $1,800 a year in dividends, in addition to whatever amount the portfolio went up or down. But what if you invested that $100,000 10 years ago? How much income would you get? Well, obviously the past doesn't guarantee the future results, but let's look at what happened over the last 10 years. You can see with the chart here that those dividends increased almost every year, such that you started off with $100,000 invested and earned about $1,800 a year in dividends. Now that same investment pays you over twice that, over $3,800 a year. That's on top of what the $100,000 grew to over that period. Now keep in mind that there were some years like in 2008 and 2009 where dividends dropped significantly, and that's not reflected in this particular chart. And there's certainly the risk that your $100,000 could drop in value. But in general, keep in mind that the initial dividend amount could grow over the long run, as might the capital itself. And that's a huge potential benefit for people investing for retirement. I want to shift gears a little bit. I talked about dividend stocks having some tax benefits. That's because qualified dividends are taxed at much lower rates than ordinary income. What are qualified dividends? Well, we'll release a video on that, so make sure to subscribe and smash the notify bell so you know when that's released. But for now, just assume that in most cases, dividends from common stock are qualified. So what exactly are the tax benefits? Well, per the IRS, for individuals whose ordinary income tax rate is in the highest bracket of 35 to 37%, qualified dividends are taxed at only 20%. And for individuals whose ordinary income is taxed at 12 to 35%, qualified dividends are only taxed at 15%. And for those in the 10 to 12% tax brackets, they pay no tax on qualified dividends. So that's pretty zesty. Where to tread lightly? The right dividend-paying stocks can be a great investment, and our next video is going to show you how to find those right stocks. So again, make sure to subscribe and smash the notification bell. But some dividend-paying stocks could be a trap. Some companies pay out very high dividends in order to entice investors to buy up shares and then push the share price up. When they pay out too much cash from profits, it means they may not have enough left over to invest in the company, and that could stifle future growth or even viability. Some companies pay out high dividends from borrowed money rather than from profits, and that's just a disaster waiting to happen. So you want to do a little digging and make sure that the company you invest in is actually profitable and that they are still investing in their own future growth. If you see a company with a very high dividend, let's say north of 5%, that should act as a red flag, and you really need to look a little further. The exception might be real estate investment trusts, as those companies must pay out 90% of their earnings. But guess what? We're going to have a special video on retirement investing in real estate investment trusts. So again, click the subscribe and the bell icon to get notified. Should you buy dividend stocks? Dividend stocks help you potentially reduce risk by buying more established, profitable companies. They might help you create a growing income stream that keeps you ahead of inflation, and they also provide some attractive tax benefits. So yes, dividend stocks merit your consideration. All things being equal, dividend-paying companies have less potential growth than non-dividend-paying stocks, only because the dividend payers have less money to invest in their own company. That said, there are plenty of dividend payers that have experienced fantastic growth, and there are plenty of non-dividend payers that have not. Likewise, there are dividend payers whose stock price has languished, and there's non-paying stocks which have skyrocketed. The decision whether or not to buy dividend-paying stocks comes down to your investment objectives and your risk appetite, and the discussion you have with your own financial advisor. make sure to speak to her before making any investment decisions. Now, for more videos on important retirement income topics and other topics, make sure to subscribe and hit the notify bell so you'll know when we release those videos. Also, we respond to all your questions and comments, so please leave a message below. And be sure to look in the description below of this video. You'll see a link to join our Facebook group where you can interact with others about retirement issues. And also, we have links to our free booklets on 10 different retirement topics. Look forward to connecting with you there.